Hello guys, welcome back to the channel. This time we will discuss about forecasting market rates, buy, sell, on ref. So here we go, let's see the video. If you're like most people who are paying off a mortgage or looking to buy or sell a home, since you pay attention to what mortgage rates are heading. Mortgage interest rates directly affects your monthly payment and the choice of owning a home banter. Consider the following strategies when deciding to buy, sell, or refinance. If rates stay the same, raise or help lower. When mortgage interest rates hold steady, average or interest rates for mortgages have been at historic lows for much of the last decade, which could put you in a good position to buy or sell a home. Low interest rates allow you to buy more house for the same monthly payment that you would be paying with a higher interest rate. Interest rates have been extremely low but are starting to rise. Most experts expecting them to continue to rise. Had the lowest average rate on a 13-year fixed rate mortgage and rates continue to stay low with some minor fluctuation through, but then started to rise in early. The Federal Reserve raised rates and is expected to do so again if the job market remains strong. While the Fed doesn't directly set mortgage rates, it does set the federal funds rate. This is the rate at which banks lend money to one another. Thanks to the federal funds rate can affect things in bond yields, which influences mortgage rates.
Belum tak tinggal soalnya naringnya.
If you were to
Mas aku tadi kemarin udah bilang Vira. Kalau ada apa aku bilang Vira Mas Yan.
And finance the remainder with a 30-year fixed rate for 5%. Your monthly payment will financing the same home at 6%. Tolerate your payment. Not amount if you can afford that extra, then you'll have to reduce your home buying budget. Simply because rates have risen. If mortgage rates drop after years of historical lows, mortgage rates have been rising. Theoretically, at some point, they could go down again. If they do, the above still holds true. If you have an adjustable rate mortgage or IRM and rate will remain the same, you may want to consider refinancing with a fixed rate loan to take the stress out of worrying about rising rates in the years to come. Interest rates for IRMs, also known as variable rate mortgages, are lower initially than fixed rate loans for a given period. 5 years, for example, after the introductory periods and rates rise according to market indexes, eventually surpassing the rate for fixed rate loan. If you have a fixed rate loan and rates fall, it may be worth looking at refinancing it into a short-term loan. For example, if you have 20 years left on a 13-year mortgage, it may make sense to refinance the remaining 20 years into a new 15 years mortgage. Rates on 15 years mortgage are also lower than 13 years mortgage. Combined with a rate drops, and you could save on the amount of interest paid and pay off your mortgage sooner. When refinancing, always consider your unique set of circumstances. Factor in closing costs and how long it will take to realize the just benefit. How long, for example, do you plan to live in your home before selling? Will you break even before you plan to sell? Generally speaking, the larger the outstanding mortgage, the more impact low rates can have on your monthly payment. You may consider if a variable or fixed rate mortgage is a better option.